This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the week. Welcome to Monday. Today, I have got a very special episode for you. We're going to do something a little bit different because I don't think there's much to do in the charts. We can certainly afford to wait another day. Don't have to be slaves to the tape. So we're going to call this one Crack Pipe Monday, and I'm going to show you a couple of Trojan horses that I believe I have found in this crypto space. We're going to be talking about the Genius Act, which, as much as I hate to say it, is actually genius. I do not respect our opponents and our enemies, but I can certainly acknowledge when somebody is a master at their craft, and hopefully by the end, if I do my job right here, you're going to see that they have really earned the respect as a worthy opponent. So, without further ado, let's get into this. I've made a bunch of notes here. Some things we know to set the scene, right, is we've got too much debt in the US and we've just crossed 37 trillion. We know we're running a $2 trillion deficit. We know that the yields have been high as a result of there not being a buyer for the debt. I mean, this is the 10-year yield still north of 4%, as hopefully you can see right here. And of course, the yields are high because the bonds have been being dumped. There is no buyer for the US debt currently, no buyer for the bonds, and no buyer for the treasuries. If I change this 10-year yield to the 10-year treasury yield, you can see pretty much the exact same thing as is to be expected. Okay, so there is no current buyer for the treasuries, there's no buyer for the debt, and that means there's not really any funding for the government. In fact, there's so little demand for this debt that the US even started to become the buyer of its own debt, the buyer of last resort. We saw a couple of these $10 billion treasury buybacks because, again, there is just no demand for this debt at the moment. There's no one to buy the treasuries, the T-bills, the bonds, et al. Now, there's a few ways the government can try to balance its books, okay? They can try to grow the economy at a rate that outpaces the debt spiral, but obviously that's not working, at least not now, okay? And with the acceleration on this debt spiral, it seems pretty much impossible that we're going to be able to grow our way out of this debt. Another way they could attempt to balance the books is to cut spending, but if there's one thing we know about the government, right, it has no history of doing well at cutting spending. It just seems to spend like a total degenerate, and it doesn't seem to be able to help itself. I wrote RIP Elon here simply because I think he did make some difference, right? He did manage to save some money, but nowhere near the amount required to start to balance the books and help balance this 37 trillion of national debt for the US. Another option they've got is they can print their way out and buy their own debt, but of course with inflation having just been as bad as it was during the C19 era, with a Fed that actually seems pretty steadfast in keeping rates overly restrictive and making sure we don't get another tick up in inflation, it seems at least for the foreseeable future, at least for the next year, maybe more, they're going to be pretty reluctant to just QE bomb their way out of this, print a bunch of money and then be the buyer of last resort for their own debt. So with the scene hopefully set now, I want to start to ask you some questions and show you where I believe I've found some Trojan horses in this space, and ultimately tie this to why we have had the US government outplay the crypto bros hand here, okay? So the first question I want to ask is, what if they have just found a way to make us buy the debt, forcing us to be the buyers of last resort? We know that we've got dollar-backed stablecoins which are ballooning in size, and I have long been making the case that this could well be the CBDC in disguise. Just because these stablecoins are not currently programmed to have all of the nasty potential things like product lock-in, expiry dates, negative interest rates, et al., does not mean that they could not update those stablecoins' programmability in the future to encompass such things. Unlike Bitcoin, which runs on a distributed network of nodes, making it practically impossible to make any major changes to the base layer code, these dollar-backed stablecoins are centralized, meaning a single entity gets to decide what happens to the code, any updates, and whether or not this becomes a kind of bait and switch to ultimately become a CBDC or something with CBDC-like qualities. If I pull up CoinMarketCap here, you can see the top two stablecoins are Tether USDT, currently sat just under 160 billion in market cap, with Circle USDC sat at the number 7 crypto spot by market cap at a whopping $61 billion. So the next question I want to ask is, what makes the stablecoin stable? Right? They take your money and they buy US treasuries primarily. Between Tether and Circle, they're currently sat on around 166 billion in US treasuries. And as a side note, this is probably the best business model in the world. Their clients give them money in the form of a dollar. They exchange this in a 1-to-1 ratio with their stablecoin dollar. They take the real dollars and invest it in US treasuries, and they sit back and slurp what is somewhere between 4 and 5% yield per year. Now, 4 or 5% of 166 billion is quite a lot of money for frankly not doing very much work. I've long been making the case that these are some of the best business models the world has ever seen. You need a very small team to be able to slurp somewhere in the neighborhood of $6 to $8 billion a year in free yield as a result of simply buying and holding these US treasuries with the client's money until such time as they want to redeem their stablecoin, and then you just reverse the process. But to really put this part in context now, okay, take a look at this right here from the BIS. Stablecoins are already the third largest buyer of US T-bill purchases. So when I said there's really no other buyers, right, we're seeing the buyer of last resort having to step in here, that was not hyperbole, right? Stablecoins are already, as you can see here, the third largest buyer of the US's debt. So here I want to say, maybe we should stop and think about this, okay? Is this a Trojan horse? I've often heard the argument that Bitcoin is a Trojan horse to get people used to the idea of using cryptocurrencies and that kind of thing, and ultimately they would switch or rug pull Bitcoin to a CBDC, but really to say that is to simply not understand how the code base and the decentralization of the nodes for Bitcoin works. But I do think we may be sat here looking at two Trojan horses in disguise. The first one is where they could eventually, in theory this is, I'm not saying they will, but in theory, they could take these stable coins and update the code base to make them more CBDC-like. Now, they wouldn't be directly linked necessarily to the central banks, but they could certainly have programmatic features added to them after the fact, something that is actually currently impossible with Bitcoin. So maybe, just maybe, the first Trojan horse is that these stable coins will eventually be updated to have more CBDC-like qualities. But the other Trojan horse here, and this is the one that blew my mind, is that they've actually found a way to use crypto bros to buy the treasuries, to become the buyer of last resort for the US's debt. So mechanistically, what does this look like? First, they would simply mandate pensions, investment banks, institutions to buy more US treasuries. Now, at the moment, there's not a great deal of wiggle room here, since they're already holding lots of treasuries as it is, they've already got their allocation, and there's not a huge amount of money in those pension funds that's just sat there freely waiting to move. But instead, they can go after retail. Why? Because this is not just pensions, it's the entire money flow in circulation. Now, we have money in the banks, and we are familiar with the 3 rules of banking, right? Number 1, it's not there. Number 2, it's not yours. And number 3, it's not real money. But we all kind of accept this because it works until it doesn't, right? We all keep money in the banks to use to spend for bills, that kind of thing. But we also know, in addition to these 3 rules of banking, that they take our money, they take our deposits, and they rehypothecate it over and over again. They lend it out for things like mortgages, loans, car finance, etc. And so the next question is, what if instead of do this, they move over to stablecoins? They take our deposits and they therefore mechanistically will be forced to buy the US treasuries. If this sounds crazy, they've actually been doing this in Japan for a while. They've been forcing their citizens to buy their own debt, and it has funded the government, and Japan is in a much better place than it has been for a long, long time. If they were to do this in the USA, it could certainly help to fund the government for many, many years to come. And the best part of all of this is that most people won't even notice or understand it. They'll be unknowingly speeding up the rate of adoption of CBDCs, or at least stablecoins, which may later be rugged into CBDCs, or at least programmable money, as I said earlier. And as a side note, this one switch is not going to fix the debt. But instead, I wanted to use this many small businesses soon make you rich analogy. If I said to you start a business and scale it to $1 million a year, it's quite a difficult task. But if instead you started 7 small side hustles, it's reasonable that all 7 of those will scale to 150k a year. And thus, it is easy to use 7 small businesses to reach $1 million a year in revenue than it is to have one business hit 1 million a year in rev. And using this same analogy, but applied and pertaining to the US national debt, it's pretty much impossible to sort this debt problem out with one single move on the chessboard. But what if instead of one single move, they have a combination of many small businesses running side by side? One potentially could be that they mark up the price of gold, they revalue the gold, and use that to balance some of the books. Another one could be that they buy 1 million or more Bitcoin, they wait for Bitcoin to hit these much higher numbers, and again, use that to balance some of the debt on the books. But one or both of these moves is not going to fix this 37 trillion. However, combine those moves with all the money in circulation being forced to convert to stablecoins off camera, behind the scenes, where most people won't even notice a difference, right? Because they will just still be tapping their card, paying for their bills straight out of their account, and they'll never really know this is going on under the hood. Yet at the same time, every single one of those dollars in circulation will now be forced to buy US treasuries, and thus be funding the government's excessive spending. And so this genius bill is just that, okay? They really did call it this, okay? The US Senate passed a stablecoin bill in milestone for crypto industry. You can see the date here, 17th of June 2025. You scroll down, they really did call this thing the Genius Act. And that's because they have figured how to make the crypto space the #1 funding source for the US government. And this thing can scale globally. If they can maintain Circle and Tether as the top stablecoins, or better yet, the only stablecoins, the rest of the world is going to become forced buyers of US treasuries. Right now, they can easily say, we don't want to buy your debt. But once stablecoins are the standard, they literally have no choice of interacting and transacting via stablecoins. And I think this is the reason that they decided to call this bill the Genius Act, because it is actually genius. So let me know what you think. Do you see these two Trojan horses? Do you think it's possible they first roll out the stablecoins and they seem pretty benign, only for eventually, once they've got total adoption, everybody switched over to the stablecoins, can they do the whole bait and switch or the rug pull, whatever you want to call it? Can they update the code base and start to add much more tyrannical and dystopian types of updates to that money, similarly to what we are observing with the CBDC type deal over in China? At the same time, as we know, the EU is talking about launching their CBDC in October of this year. And number two, have they allowed this whole crypto space to continue to thrive? Have they allowed the whole thing to be full of speculation, meme coins, altcoins, for the hype to build over and higher in this space and in this industry since its inception, all as part of a plan to slowly roll out the adoption of these stable coins, forcing the entire space and the rest of the world to become the buyer of last resort for the US's debt? Is this some of the reason they don't care about running the debt up, because ultimately they know that it's us that's going to have to buy it? So I'm your boy Camel. Welcome to Crackback Monday. Welcome to the week. And until next time, take care. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game.